Hi, everyone. Welcome to KPN Associates Thursday, 1 o'clock panel and the Q&A. Today, Angus Shuttleworth is joining us, and we're going to talk about tax. And the tax season is now. We're in the height of the tax season. We're in the height of the RSP. Everything that's going on in regard to how you can save or how you can pay tax and go forward with that. So Angus, first of all, let me ask you a couple of questions before you start your presentation. I wanted to ask you your background and talk to me how you got into being what you're doing.
Yeah, so I went to Brock University for accounting. And then, after I graduated, I worked for PricewaterhouseCoopers for about 5 years.
Yeah.
And then I started my own practice here in Burlington. I've been pretty involved in the community as well. I've been like a member of the Rotary Club of Burlington Lakeshore. And I was the president, I've been the chair of Ribfest. I'm so quite involved in Ribfest. And now I've got 3 young kids. So I find that that's where I'm spending most of my extra time. But like my 2 older boys are in rep hockey. And then my younger daughter, she's 4, so we're just starting to get her into programs. So getting to the busy part of life.
Yeah. Costly and busy. And also and maybe trying to find those tax write-offs with the children, right?
Yes. Yeah. Well, my 4-year-old just finished daycare, so that was a big write-off that we are no longer looking forward to.
Yeah. And I wonder if a lot of parents know that. I'm sure they do, but it is a big write-off. It never used to be, but it is now, right?
Yeah.
And so you said you're a Rotarian?
I am. Yep.
Yeah. And I'm a Rotarian also, right?
Yeah. Oh, which club are you with?
With the Burlington North.
Okay, right on.
Yeah, I've been there for, I guess, over 18, 20 years. And so, it's a wonderful situation to be in. We actually talked about that last week. Okay, so let's start with your presentation. I'm as far as my questions, what I did at the very in the middle of this week, I sent to Angus some questions, and what he did is he put together a presentation, which I think is fabulous because it will answer, as he mentioned, it will answer a lot of the questions that I had for him in regard to our Facebook followers or even the general public. So Angus, you're on.
Yeah, so I think the first question you asked is just sort of the main benefits of the RSPs. And I sort of think of there like 3 of them, I guess 2 main ones that apply to most people. And it lets you shift income from one year to the next. And it also allows you to defer tax on the income that you're earning inside the RSP. And then there are also benefits for first-time home buyers that we'll get into. Yeah, so I figured I'd do a presentation because I don't know, the numbers, it gets a bit confusing. But on the left here, those are the tax brackets. And that's where, so if you're looking here, if you're earning over $221,000 in a year, your tax rate is 53%. So if you make an RSP contribution there, you're going to get just over half of that back in reduced taxes. Whereas if you're in the lowest bracket, 46%, your tax rate is 20%. So you're only going to get 20% of your RSP contribution back. So this time of year, I'm getting a lot of questions from clients that are saying, "Oh, Angus, RSP deadline, how much should I contribute to my RSP?" And so that's what I'm thinking about. What bracket are you in? What's your sort of historic normal tax bracket? And because some people, maybe they lost their job during the year, so their income is low this year. And then maybe other people got a really big, unusual bonus. And so then you can see, okay, let's make a bigger RSP contribution this year, or let's do a smaller one and save it for a future year. And so I just did a little example. If we have $1,000 that we can your RSP, what is the impact? And so you're at the top rate, you're going to have, without making the contribution, you're going to have $464 left. And at the lowest rate, you're going to have $800 left. But then if you put the full $1,000 into an RSP, then you have the whole $1,000 to invest.
Yeah.
And so purely, if you just think about, okay, let me put $1,000 into an RSP this year when I'm earning 221, and then I'm going to take it out next year when I have no income, right? That on its own is going to save you like $335 just by shifting over those 2 years.
Right.
And
Yes. So with the RSPs, so the full, say you have a lifetime of RSPs, you can contribute, Angus, how much over a lifetime? And I'm only asking this for our viewers.
so it's 18% of your earned income to a maximum, I think it's about $24,000 a year. So it's different for everybody. But that's roughly what you're looking at. And that's sort of a good question to ask, because that's another thing that I want to know about is how much available room do you have? Because I had a client here, we've got a new client, he has $200,000 for RSP room. So he could make $100,000 RSP contribution this year and probably not impact his ability to make a contribution in a future year. Whereas someone who's got $20,000 of RSP room, if they want to make a $40,000 RSP contribution next year, the amount they contribute this year is going to have a significant impact on that number. So you want to just keep that in mind. And then on that strategy, if you're going to put $1,000 in this year and take $1,000 out next year because your income's low, if you have $200,000 of RSP room, you don't really mind. But if you have $1,000 of RSP room, now you've just wasted your last $1,000. So maybe that strategy is not going to make sense.
Absolutely. Now, everybody talks about contributions and how over the lifetime they can contribute, but nobody ever talks about the end. So, which I'm talking about when you turn a certain age, then it stops. You cannot contribute anymore. And then what can you take out as a senior and you've passed that age? I believe it's 71, 72. Is that correct, Angus?
Yeah, so at the end of your 71st, the year you turn 71, like that's the last year you can contribute to your RSP.
Yeah.
And then next year you have to convert it into a RIF, Registered Retirement Income Fund.
Right.
And
so talk
yes.
to us about a RIF and how that impacts how that impacts the person that's holding, that has the RSP to a RIF.
So there's a lot similar, right? So if I have an RSP right now and I want to take $10,000 out, I can pull it out and I'm going to pay my regular tax on it.
So is that half of the 10,000? So you realistically get 5,000.
It'll depend on what your tax rate is, right?
Okay.
Like if you're in the lowest bracket, it's going to be 20%. Like there's a mandated amount that the financial institution has to withhold, but that's not actually the tax that you pay. It's whatever your regular rate is. And it's the same with a RIF. The two differences, and I have discussions with people, when they're 65, in that area, because if you convert your RSP to a RIF and you take money out of that, it qualifies for the pension amount. And if you're earning pension income, you can split that with your spouse, and you can also get a $2,000 extra credit.
Huh.
So if I'm 65 and I want to take money out of my RSP, I could just take it out, pay the tax, or I could convert my RSP into a RIF, take it out as pension income, and then split with my spouse and get the credit. The downside to a RIF is that there's a mandated amount that you have to pull out every year.
Yeah.
Right. So it starts around 4%, and then it gradually goes up every year, and by the time you're 90, it's close to 20% that you have to pull out,
Wow.
right? So, because the idea is CRA doesn't want you to die with money in your RSP, basically, right? So they want it to all come out, and so that's why
That's interesting, isn't it? Well, we could die at the age of 75 or something. I'm kidding. I'm kidding. That's an interesting comment, but that's true, isn't it? The CRA doesn't want the problem of having anything to take care of in the end result, right? Okay, so let's go on to the next topic that you next slide.
It's sort of related. So we're looking at the benefits of a tax-free savings account. So
this is my favorite. I love tax-free savings account.
Yeah, they're great. Yeah. So in RSP, basically you put the money in before tax. So you have $1,000, you put it into an RSP, like you get the tax back. So you do that full $1,000 is no tax. Going into a tax-free savings account, that $1,000 will turn into, if you're 20%, it's going to turn into $800 that you can now contribute to the tax-free savings account. But it earns inside the tax-free savings account tax-free, and then you can pull it out tax-free. So it's very flexible. And that, sort of going back to our last comment on the RIF, pulling money out of your RIF, it's taxable income. And as you're getting older, the amount that you're pulling out is getting higher. And seniors have a few benefits that are, tested for your taxable income, like guaranteed income supplement and old age security. And once your income gets too high, then you lose those benefits. But taking money out of your TFSA doesn't impact that. So it's a huge advantage.
Yeah.
And then you're also able to, it's like in your RSP, if you put $1,000 in this year and take it out next year, you're not going to recreate that room. You're going to have to use new RSP room. Whereas a tax-free savings account, you take it out this year, it's going to generate more. It's going to give you that room back next year.
Yeah, and if you invest it, for instance, interestingly, one year I invested in, I think it was about $10,000 in Tesla, and it grew suddenly right up to $1,000. So I tripled my money actually, and so I pulled it out, no tax, no tax. It was beautiful. And I sat there and I thought, I can't believe the government gave this to us. Thank you. So anyway, I shouldn't talk very loudly about it, should I?
And I mean, that was happening. I mean, that does happen, and people were playing games, especially at the beginning of the tax-free savings accounts. And they were moving money from their tax-free savings accounts to their RSPs, and the financial institutions thought it was just registered accounts, so they didn't really mind. So they would see, like, they'd do it even intraday. So like, oh, Tesla today is 800. Ooh, by the end of the day, it's 1,000. So they'll call their broker and say, hey, please move that from my RSP to my tax-free savings account, so they can get that $200 tax-free. And then they'd flip it back to the RSP later, right? And the government kind of figured that out. And there are people that have made, like $2-3 million is their like tax-free savings account balance, because they just invested very aggressively and had a lot of growth.
So it's interesting because I've always wondered, because when my accountant and I had a discussion about the RSPs and contributions and when it stops, etc. I asked him a question, and maybe you can answer this, Angus. Why, there are so many more people working over the age of 70 to 80, and they're healthy and they're making money. Why do they insist on stopping the contributions at 71, 72? And it's just an honest question. Why would the government put that particular number or age?
I suppose it's because retirement age is 65, so they're giving people sort of an extra 7 years. But it's that, and this is the there's tax-free savings account, there's no, it just, you continue to generate the room, right?
Yeah,
Right,
yeah,
all the
yeah.
way, but the RSP, they do stop it at, and I guess it's that they want you to pay the tax eventually, right? So they want to make sure that there's some sort of a sunset clause,
Of course.
you know?
Why didn't I think of that?
Yeah.
Yeah, that's true. All right. Okay. So the next question I address, and let's go on to the next slide, and we'll talk about that.
Yeah. So you asked about a couple benefits that there are to, help people get into their like first home, and this has been around for a long time, the home buyers plan.
Yeah.
And that, so you make contributions to your RSP, and then you're able to take up to $35,000 out tax-free for a down payment of your house. And then you have to repay that over 15 years. So you either put the money back into your RSP or else you bring it into your income. You have a choice. And yeah, so they give you a 2-year break, right? So you take the money out in 2023, then starting in 2025 is when you have to put the money back in. And
So okay, so a couple of 70,000 with no tax, with tax required income is 87,500. Yeah.
yeah, so that's just going back to those tax brackets. If I'm in the lowest tax bracket and I want to come up with $70,000, I'm going to have to earn 87,000 over time to have that 70 after tax. And if I'm in the top tax bracket, I need to earn $130,000. Right? So it's just much easier and faster for me to accumulate that down payment using the RSP. And that's, so oftentimes what I say is, it's good to contribute to your tax-free savings account regardless, because it's such a powerful vehicle with the flexibility and the tax-free earnings. And it's really, in later years when you want to pull the money out, not having to pay tax, it's going to make a huge difference. And so generally you want to be in a higher tax bracket making RSP contributions. You don't really want to contribute to your RSP in a low tax bracket, or it's not really a priority. But when you're buying a house for the first time, you're still having there's a $17,000 advantage using your RSP when you're in a low tax bracket to get that initial down payment. So in those cases, so I might be someone who already owns their house is in the 20% tax bracket. I might say, okay, let's not do RSP. Let's focus more on the tax-free savings account. But then if they are trying to buy a house, I'll say, okay, no, let's fill up that RSP as best we can so we can accumulate that down payment.
Okay.
And then there's a new program that I think you're going to like, Karen. I'm not sure if you've heard too much about it, but it's a tax-free first home savings account.
Yep.
And that functions almost like a tax-free savings account, and and an RSP blended together, right? So you can contribute up to $8,000 a year. You put that in, you're going to get a tax deduction, and then it's going to grow inside the account tax-free. And then when you pull it out, it's tax-free. So it's almost like
no tax at all, never any tax.
That's right, as long as you're using it for a down payment on that first house. So that's very
fantastic.
Nice.
So if you miss a year, you can add up to an extra 8,000 in a following year. So yeah. Okay.
Yeah, so it's like you have the account that it's open for 15 years. Right, and then you have to wind it up or pull the money out, and you can contribute up to 40,000. So yeah, you could do 8,000 a year for 5 years. Boom, buy your house. It's just hard for people starting out to come up with $8,000 a year.
But on the other hand, 40,000 is not very much to buy a house these days. To have a down payment, So it adds. I mean, it adds to the fact that you're not borrowing from your parents. No, I'm kidding.
Yeah. Right. Well, it's like you get the tax-free amount, right? So,
Yeah.
and I mean, if you think about it, you can have the 35,000 from the home buyer plan, and then the 40,000 from the first home savings plan.
Mhm.
So you get 75,000 per person. So a couple can have 150,000.
Yeah.
Sort of tax advantaged down payment on that first house. So,
Mhm.
so it is. It's quite nice. And then if you end up not ever buying a house, you
Mhm.
can transfer the money into your RSP,
Oh, okay.
and it doesn't actually affect your RSP room. So,
But then if you transfer it into the RSP, when you take it out, then it's taxable.
yeah,
So I would personally take the 40,000 and transfer it if we had room in there to the TFSA.
but then you have to pull it out and pay tax anyway, right?
Oh, okay.
Yeah, and just because so it's like the RSP, they're both like before tax, whereas the TFSA is after tax. So then that would be the thing to do, but they don't like that.
Shoot me.
Yeah. Sorry.
They get you from every corner, don't they?
Yeah, they do. Yeah.
No. I hate to think about your job, Agnes, and people coming at you and saying, well, why, who, what, where, and all these numbers flying at you going. So I just have a funny question for you in regard to this. Do you think this is a fair FHSA saving situation? Do you think it's beneficial for the first time home buyer? As an accountant, do you think it's a good thing, or could they have improved on it?
Yeah, I mean, I think it's a good thing. Like, I don't. It starts at 18. Maybe I would have allowed it to start a little bit earlier, just to give. But I guess it doesn't really matter because kids aren't earning very much money. But the thing that it's just hard for people to come up to that money. They come up with that money early on in their working careers.
Yeah.
Which is who it's supposed to help. But I think it's great the way it is, right? It's better than the first time home buyers plan, because you don't have to ever pay tax on that money when it comes out.
Mm-hmm.
I mean, I do wonder sometimes, there was a few months ago, the US government announced a $10,000 electrical vehicle credit.
Yeah.
And then all the electric car companies increased the cost of their cars by $10,000, right? So it didn't end up helping the consumers at the end of the day. So you wonder sometimes, the government put in these programs, people have a budget. It's like, I can afford $4,000 a month for my house. And then the government adds these extra things, and it's like, oh, good, now I can afford $4,400 a month. Oh, look, the price of the house magically went up, so that now I'm buying the same house, but it's costing me more.
How true. Good point.
Yeah.
But so talking about the US, but the Canada had that. They implemented something out of the federal government for a credit or a rebate or something for an electric car. Did they not at one point?
Yeah, I think there is one.
Yeah.
Yeah, there's still one. Yeah, I mean, that's the.
They're still going. Okay. Yeah.
I believe it is. Yeah.
Well, I don't own an electric car. I own an electric car, but I've heard about it, that if you get a certain amount for you, I don't know what it's all about, but maybe you can explain that, or maybe you don't even know anything about it either, because it's not really anything to do with tax, is it?
Yeah, it just happens.
Yeah.
Doesn't really touch me that much. But yeah, just that's the whole thing. Government bring in these incentives, and if you're not careful enough, the incentive actually just inflates the cost of things.
Well, it's interesting, when you talk about incentives, and I'll just touch on it, but so many people, so many incentives do come out, and we know very little about them. They're not announced. They're not. Nobody talks about them. There's heat incentives. There's construction incentives. There's all kinds of incentives, but you have to go searching for them on the computer, and it's not. The government doesn't make a huge announcement about it, and so you have to be innovative and think, okay, well, let's see if there's an incentive, right?
Yeah. And then, they change quite a lot. So it's hard to keep on top of all of the.
Yeah, you're right.
various
You're right.
things.
You're right.
Yeah.
So when your children grow up, because you mentioned you have 3 young ones, when your children grow up, what do you think the tax world is going to be like for them in regard to what they can do and how they can, they can save? Are you saving for them now? Are you contributing into, let's say, this FHSA right now?
I mean, I can't contribute into that, right? Because you have to be 18 years of age.
Okay.
Right.
Good.
So that's, I can't do that with the kids. I'm contributing to their RASPs. Right. So that's the main thing that I'm doing for them. And I'm wondering, this almost is, I think I almost need to buy them each a condo now, so that they're at least in the market, and, because it's just, our house went up like 3 times in the first 5 years that we owned it. Right. And it's just like, things just get out of reach.
Yeah.
But then if I were to do that, then they're not going to qualify for the tax-free savings account or the tax-free home savings.
Oh, true.
Account, because you have to be a first-time home buyer.
True.
Right. And then they wouldn't benefit from the RSP either. So I guess I can buy it in my name and then sell it to them. But I need to look at that and see, there might be some sort of a
well, what about
anti-avoidance provision to prevent me from transferring it to a related party and benefiting from these tax accounts.
So if you put it in trust to them, no?
Yeah, I think I'd have to buy it directly.
Yeah.
And then I'd have to sell it to them.
But then you pay capital gains, right?
Yeah, I would.
Oh.
Yeah.
It's crazy.
Yeah, so it's just, what is it? Is it better to pay the capital gains and allow the kids to access these programs, or is it better to have it in their name right from the start and give up on these programs?
Yeah, because as they grow up, you're going to rent it out, and so you're going to pay tax on that income. And then once I have some clients who keep their properties vacant for tax write-offs, right?
Yeah.
It's interesting.
Yeah. That's actually a great segue to the next change that they're pushing through.
Okay.
So the underused housing tax, which I don't know if you've heard of that.
Yep.
Yeah. Yeah. So basically, they're going to charge a 1% tax on the value of the house, and they're targeting foreign-owned property. But the net they're casting to target those properties are pulling all kinds of other entities in. But generally, if you're owning the property yourself and you're a Canadian resident, you don't really have anything to worry about. But if you're owning it through a corporation or some sort of other structure, it's highly likely that you have to make a filing every year. You likely aren't going to owe any tax, but you still have to file a paperwork. And not filing it, there's a $5,000 penalty, which is quite a big penalty, especially when the government is not getting any tax for it.
Well, and so when you look at this and you see the tax 1% of the value of the house for the foreign-owned properties, and the Canadian citizens do not need to file. Well, if you ask me how many Canadian citizens own houses that are vacant, I would have to sit here and say, I'm baffled by how the government is selecting the foreigners rather than all of the whole issue, because there are a lot of vacant properties owned by Canadian citizens. So why would they not tax them, even if it's under corporate or personal?
Yeah. I mean,
You
it's
know?
almost like they're picking on the people who don't vote for them, or
Yeah.
can't vote for them. And then, yeah, if they forced everyone to do this, it would probably have a bigger impact at helping the housing shortage. But then they're going to have a lot more people mad at them.
But I have to tell you also that the foreign-owned properties, the foreigners, the international groups of people that come in to buy, and again, they're penalizing them because of the purchase, because there's a tax on the purchase also if you're not a citizen, and they are the ones that have money to come in and do this. So, I'm baffled by the whole thing. Anyway, I
One
should
of
be.
the accountants I used to work with, he had Eddie's theory of legislation. He's like, legislation can only be written by people who know nothing about the subject.
And I agree with that, because they have not involved. It's like putting a president into a man who becomes president of a company that he knows nothing about.
Yeah.
And he doesn't even know how to run the company, right? Yeah. Take a deep breath, Karen.
Yeah. So it's, and this is like, and I love that the filing deadline is April 30th. It's like, oh, good, I don't have anything else going on April 30th. Now I can worry about all my other clients that have a different year end that, like I have some guys with the July year end. It's like, oh, do they have a property in their company that I have to worry about now?
Yeah.
I better tell them.
All right. So any other interesting information that you can give us, Angus? Anything else you wanted to address, because we're almost up for time, and I wanted to ask Michelle, Carrie Ann, or Sasha if they have any questions.
So that you did ask about like how to get your tax return filed.
Yeah.
And CRA has a big resource with their, I don't know, it seems like there are 30 or so softwares that help people file their taxes. Some are free, some are like freemium or whatever. And a lot of times now, if you have a fairly simple tax return, you could probably do it yourself without too much trouble. But I do find, like, every year I have a client, and like, your return is so simple. Why are you paying me to do it? And then something will end up happening. And it's like, now I understand, and it's actually paid for itself. Like that I've been here to help you for the last number of years, so it's almost a little bit of an insurance policy, and then it's good to have a relationship, because I'll get people that come and, they'll have something really weird that happened this year. And it's like, oh, Angus, can you please help me with this? And I don't have any history, and it happens. I guess the most I see that is, like a parent will pass away, and then they'll say, oh, can you please do my parents' tax? Then I don't, it's so difficult now for me to get access to the CRA account, and then trying to get up to speed. And it's just very frustrating to try and work on those files. Whereas if you have a history, it just makes things much simpler. And so that's kind of you can do it yourself, but it's just sometimes there's a benefit.
Exactly. So Angus, you have your own company, right? It's Shuttleworth and Associates.
It's Angus Shuttleworth CPA Professional Corporation.
Okay. So everybody look that up, and we're actually going to publish it on Facebook, and we'll do that. But meanwhile, Michelle and Sasha and Carrie Ann, do you have any questions of Angus? Michelle?
I don't have a question, but I think that's great that you came on, because this topic has been is usually, especially for, like, I feel the younger group, even for me, I'm in my late 30s, but it's still such an intimidating topic that a lot of people are afraid to ask questions for, or, kind of dive into what options they have. So it's really great that you've broken down everything for us. So thank you for that. I don't have any other questions, but it was really great to to hear everything, kind of lay everything out for us. So
Yeah,
That's
thank you so much for inviting me.
That's a good point, Michelle. And that's interesting because maybe our Facebook followers and then some, maybe they want to see a possible course in our training room to invite them for an evening and just sit and listen to what they have to do, because even owing taxes is daunting. I know a lot of people who don't even know how to pay their taxes, but also they owe taxes and they don't want to talk about it, and so I'm sure Angus runs into everything, correct?
Yep, yeah, I've seen lots of different things. Yep. And some people, I don't want to file my tax return because I know I owe. It's like,
yeah.
you're creating bigger problems.
Oh, for
You know?
sure. Yeah.
You're guaranteed going to give the government 30% more than you have to, but go ahead.
Yeah. So Carrie Ann, do you have any questions?
No, I think that was great. Actually, how to file a tax return, what is the range of pricing that it would cost for someone to file a tax return?
Yes, I mean, for me, I charge, my minimum is $200 for sort of your standard simple return, about 6 slips.
Mhm.
And then it just, depending on how complicated it sort of becomes from there,
Mhm.
it changes.
I actually had a two-part question. The first one being, is there a specific software or program that's suitable for a specific employment career that works better if you want to file your own tax?
I don't know, I use Intuit software. The software that I use is Profile, which is a professional grade software, but they make TurboTax. So I mean, it's just I know that the quality of their software is good, but I think there's a fee for that one.
Okay.
But yeah, I mean, there's just so many, right? There's 30 of them. I couldn't really give a good
Yeah,
recommendation without studying the 30,
Right. So that was my other question, if you would recommend a certain program over another one for a specific job.
Yeah, I mean, it's just because I don't work in those softwares really to be able to recommend.
Yeah.
I mean, I think you probably, if you're just your standard, I have a T4 RSP contribution slip, you could probably use most softwares. Some of them might not be that user friendly. I know one of my friends asked me one year, he had a question dude, your program is making me insane. Let me just do it for you, But then once you're self-employed, employment expenses, that's where it becomes a little more complicated. And I think it would be more important to have a more robust, longer term, a company that's been around for a long time, that's been able to work out those different wrinkles.
And I think if Angus is only charging 200 or and up for a return, I would actually go to him and say, here, take it away and just do it, because it's worth $200 of my, especially of my time sitting in front of a computer putting in figures. Oh,
Yeah.
And who's to say that you're not going to get it wrong? And then the government writes back to you and says, okay, we've reassessed you and it's another 39 cents. And so see, the thing is that when you have it done by an accountant, as Angus is, you're reassured that it's done, and it's done properly. We're professionals in real estate. Let's deal with the real estate, and the accounting goes to the accountants, right?
I find those CRA letters, they scare people. It's they get a letter from the CRA and it gives them a heart attack. I'm I don't know, there's nothing wrong with this. Letter's perfectly fine. It says you're getting back $3,000.
I'm one of those. I guess I'm one of those.
Same.
You owe $345. You missed this and it's reassessed. And I'm going, what the hell is this? It's too bad you don't have a representative at CRA, one representative, like Harry, your representative, and you just pick up the phone and go, Harry, why did I get this letter?
Yes.
But you don't. It's always a different person.
Yeah.
Anyway.
And you call about the same question, you'll get a different answer each time too. So
I don't want to hear that anymore. Oh, how funny. Anyway, thank you very much for being on. And I really, really appreciate you answering all these questions for us. And actually, it's a concept that I would really like to maybe take a little further, is a training course, and inviting all our Facebook followers to come one evening to our training room, because we have a beautiful training room in our office. And so, Angus, I would invite you to come and do that.
And you're right around the corner from me.
Oh, where are
I
you?
believe. I'm on Glenwood School Drive, which is just other side of Guelph line from where you
Oh,
guys
yeah,
are.
I know exactly where you are. Yeah, I know exactly where you are. Yeah. All right. Well, thank you very much. And everybody, tax, file those tax returns and pay those taxes. And I hate that word. No, I'm kidding.
You're going to like my website is burlingtonaccountants.ca. So that's nice and easy to remember.
Does it have smiley faces on it so that at least
I added it onto our Facebook page on the comments. So if you're wanting to go to his website, it's in our comments on the panel.
So thank you very much, everybody. And thank you, Facebook followers, for chiming in today. And I hope this has given you some more knowledge in regard to taxes. Remember that we are the largest company globally. We have over 178,000 agents across in the world, and we would love to do business with you. And if you're asking yourself the question, should we sell? We have answers for you. Please contact us and we can tell you the answer for that question. Okay, thank you.